Welcome to the Media Hunt Report. Happy New Year to everyone. I've got a special guest today in Jeff Roberts. He's a specialist, a global specialist in financial risk management. Jeff, welcome to the show.
Happy New Year, Steve. It's a pleasure to be here. Looking forward to this year again. I think last year with the financial markets over the place with oil, with the Russia invasion of the Ukraine, with food shortages and these things going on, had quite a dramatic year and influences not only on the world but also on Australia and New Zealand.
Well, I'm very interested to know, given the talk of recessions and all of that kind of thing. I think the US is priced in the 65% prospects of a recession. You've got interest rates increasing. What does that mean for lifestyle markets like the Gold Coast, Byron Bay, New Zealand? I'd really interested to know. I'm sure my viewers would be very interested to hear what you've got to say.
Look, I think some interesting things happening. As you said, 65% probability of recession in the United States. In Australia, we are all expecting another interest rate hike at the start of this year coming. All of those things, why are they being driven that way? It's trying to control consumption down because we want inflation to come down. So that's, first of all, the premise or the backdrop of what's going on at a macro level. In terms of behaviours, what's changed? This is not a GFC sort of scenario where it's a surprise, interest rates are up and people can't pay their mortgages. What's changed this time around? During the pandemic, companies made money, individuals made good money, but they also changed their lifestyle. And what they wanted to change in their life is they realised working in London, working in New York, you can make money but you're living in apartments or your lifestyle is on a subway, where people have sort of realised, I want to have a nice lifestyle, I have the cash, I want to invest in places that can provide that lifestyle. So we're seeing some really interesting things occur in the world. One, billionaires are buying and creating bunkers in New Zealand to hide from these problems that are happening in the world. So that's one dynamic that we're seeing. Then if you look at it on a mainstream basis, let's take the Australians, the New Zealanders that have worked offshore, not only the migrant community of internationals, they're coming back to Queensland, beautiful place, lots of sun, good surf lifestyle. I had a surf this morning, Steve, it was magnificent. I'd like to live here and I'm looking at that myself. But the key message is good assets will be in demand.
So, Jeff, you've been in the industry for over 30 years. You've seen the cycles. You're right in the thick of the GFC.
Yes.
So how do you see the whole economy sort of playing out over the next few years?
Controlling inflation is really the objective of all central banks and governments. They don't want sticky wage inflation. So sorry to say to most people that governments don't want to see wages going up and staying up on a contained basis because that's going to have sticky inflation. And we don't want sticky inflation because it keeps interest rates up. What we should probably be looking for in terms of looking forward and managing our risk, whether we're construction, whether we're funding projects, or whether you're going to buy assets, is interest rates are likely to stay up for a period of time until we see inflation roll over. Okay? So if you're watching the market going forward, it's what are the inflation indicators that are going to roll over? Wages, any consumption and oil price, energy prices coming down.
So we work with a lot of property development companies throughout Australia, obviously centred around the Gold Coast and southeast Queensland predominantly. So what would be your message to them in terms of the headwinds that they are well aware are ahead of us? You've obviously got the backdrop of strong migration into Queensland because of the lifestyle factors that we've spoken about. So what would be your advice to them?
Look, I think the construction companies you deal with, and I've seen the portfolio, these are large projects, and I'd imagine they have already seen the change in the cost of funding. Well, they have, and they've been managing that risk. The question I have for them is, do they have flexibility in that management? What does that mean? Effectively, using hedges, which is insurance effectively, against interest rates going up, but being able to participate in lower cost of funds. So that's probably the most important. The second one is holding some firepower of capital, because we will see assets at lower levels, some assets, and good land, good construction holds its value in the medium term. I've seen these cycles over the medium term. It's about being calm, well planned, and executing that strategy with the turbulent waters that are coming in 2023.